The Fed faces its next data hurdle with its easing cycle hanging in the balance. Firming bets that the Fed is primed to resume cutting interest rates will be tested by this Tuesday's release of US inflation data. A hot number could shake the narrative that the Fed will cut rates at its next meeting in September, which has gathered steam after surprisingly weak employment reports earlier this month. Janet Moy is head of market analysis at RBC Brewin Dolphin. So Janet, June inflation data showed the biggest rise in 5 months. What are you expecting this month?
So I guess it's fair to expect that the US inflation will pick up slightly both on a headline and a core perspective. In fact, we have been seeing core goods inflation edging a bit higher over the past couple of months. So I guess that's the starting evidence of tariffs. So we expect that to be slightly more apparent, but probably still not reflecting the full impact yet, of course, because we have been, having changes here and there, and also companies are still running down their inventory. So I guess that should put inflation a bit higher. But on the other side, we have to remember that shelter inflation is actually the biggest part of U.S. inflation basket. And on that front, we keep seeing a slowdown in the rental component. So the official measure is often a bit lagging. If you look at the Zillow Rent Index, it has been running at about 3% year on year, which is way lower than what the CPI is implying. So I guess there's a bit of push and pull factor on inflation, but I think the markets are currently expecting a slightly higher inflation compared to last month.
This is the first release by the BLS since President Trump fired its chief. Can we fully trust the numbers to be free from political interference?
Well, I guess it's a bit too early to expect that sort of influence. I guess I think we have to understand that the collection of these CPI data, it has been following a certain methodology for ages and is carried out by professional and experienced staffers and calculated by statisticians that has been with the BLS for a long time. So I guess it is a bit too premature or dramatic to worry too much about the trustworthiness of these data. But I understand the market's concern. I think if we see data that is dramatically different or deviate from what we usually tend to see, then obviously it raises question, and the markets will definitely scrutinize that. But I don't expect that to really happen here.
Let's switch now, Janet, to the jobs market, and continuing claims rose to the highest since the end of 2021 last week. Is the US labour market in trouble?
I don't think the US labour market is in trouble, but there is indeed some weakness that is showing up in recent data. As you have said, it's a continuous claim edging higher, is the recent job creation that has been dramatically slower, unemployment rate edging up, and the labor participation rate is basically slowing down. So these are problematic, but it is not falling off a cliff. We have to understand that. It's still relatively healthy. I mean, we basically had very strong labor market gains, and the market has been very resilient over the past couple of years despite so many challenges. So we're pretty much in late cycle stage, where slowdown in this sort of data is pretty normal. So I guess it's really the extent of the slowdown. Are we going to tip into recession? And I guess that the question is no.
Comments from Fed's Bowman over the weekend as well. She said she favours 3 interest rate cuts this year. Do you see this as likely?
Well, I guess that's a pretty rapid pivot from the Fed. If we see 3 rate cut, it basically means 1 rate cut in September, October, and then December. And for that to happen, we need a much weaker labor market, and importantly, we need inflation to be slower than what we currently see. So it's not entirely impossible, but I guess it's a bit difficult. I would expect maybe a first cut in September, and then the Fed to move cautiously depending on the data. Perhaps another rate cut in December, but I see 3 rate cuts from now is pretty challenging.
Meanwhile, 3 other policymakers have expressed concerns of sharp cooling in the labour market. Could we see more dissent among the central bank?
Again, I think it's possible, because right now we're at a junction where the data is not entirely clear at the moment, and there are certainly policymakers that are worried about the impact of tariff on inflation, and there are some that are less worried because they thought tariff is more transitory and they focus on the weaker labor market. So I think the right now is quite balanced in terms of the view. But as I said, if the data starts to worsen on the labor market front, and if indeed there's not too much of an inflation shock from tariffs, then I guess the tilt of the Federal Reserve balance can be towards the dovish side. That's entirely likely.
That was Janet Moy from RBC Brew and Dolphin. Don't forget, you can watch more videos on Reuters.com.